I'm John Marino, Senior Editor at The Deal, joined today by Kent Rowey, partner with Allen & Overy, to discuss infrastructure. And it seems like we've had a lot of infrastructure funds getting raised over the last few years, probably looking forward at some potential opportunities. Where do you think private equity is looking to make deals?
Well, look, John, it's been a slow burn so far. I mean, really beginning in 2006, that's when private equity started moving into infrastructure, especially transportation infrastructure. Since then, there have been several deals that have gotten false starts. A few deals have been canceled, having somewhat of a chilling effect on the market. I think over the last 2 years, there's been a big upswing in momentum. Several deals have gotten closed. There's our Ohio Rivers Bridge project in Kentucky got closed, the Goethals Bridge project in New York, which got closed. New procurements underway in California and in Florida. So I think there's a swing of momentum in the market at the moment. Now, there are really two areas where private equity looks to invest in this market. The first is the so-called brownfield market.
Right.
Okay, those are existing assets that generate revenue. And those are typically characterized by an upfront payment by the investor in exchange for taking over the operations of the asset and making money from collecting fares from users. Okay, you've seen deals in that space in the parking sector, you've seen it in the toll road sector, and lately in the water sector. I think there's going to be a lot more of those to come. The other side of the market is the so-called greenfield market. This is new construction, new facilities being built. Toll roads, bridges, especially bridge rehabilitation, is a very interesting market at the moment. I think there's going to be a lot of opportunities in those spaces, and I think that's where you're going to see the capital heading in the next few months to 2 years.
All right, that's an interesting point. How about airport deals? It seems like there are a number of jurisdictions that could probably benefit from a little private capital coming in and supporting these airport operations from a number of different perspectives.
Absolutely. So first of all, I would say that the interesting part of an airport really comes from the public sector. Municipal airports don't make any money at all for cities. It's not a revenue producing asset. Okay. So there's an impetus on the part of municipalities to determine a way to monetize the municipal airports that they have responsibility for. Midway was a case in point. On a slightly more successful and happy note, the LMM airport, Luis Munoz Marin Airport in San Juan, was completed and closed under the FAA privatization program. In both cases, the authorities, the public agencies, were motivated by monetizing an asset that produces no revenue at all. So I think they're a great asset for this technique. At the moment, there aren't a lot of airports that are suitable for the FAA privatization program. Right. But I think despite what happened in Midway, there's just too great an incentive on the part of the public sector not to see more airport deals get done.
And you've mentioned Midway. That's something that we've covered, especially recently, obviously, given the second blow-up of a Midway deal. Yeah. Is it just Chicago, maybe? Or to look at this from another perspective, what do politicians have to do when they're getting into these kind of P3 deals to kind of insulate themselves?
I think they need to understand them first. I think one of the difficulties in the P3 market is that there's been a lot of disinformation, almost demonization of the techniques and the investors who've been involved in some of the very high-profile deals. So you mentioned Chicago. I should declare an interest here. First of all, I was involved representing the investors in the Chicago deal, so I'm very familiar with it. But that's a great case in point. That's an asset that was ripe for privatization. Right. Since the private sector has taken it over, the service at the on-street parking bays has been better than ever. It's rated one of the best parking systems in the US. Yet you read the Chicago newspapers and everybody hates the deal. It makes absolutely no sense at all. Service has improved dramatically. And I think the problem is that a lot of our policymakers don't really understand P3. Governments have been funding their infrastructure through tax-exempt debt, through grant money, and so bringing the private sector in is not a familiar technique to them, and there's immediately some suspicion that attacks to a private investor investing in infrastructure. There's no need to have this sort of suspicion. I mean, all of the deals are protected by contractual structures that protect the rates. It's a utility asset, essentially, and that's basically what the Chicago on-street parking deal was all about. Now, to your point on Midway, I think the problem was really twofold. First, the environment in which Midway was launched, I think, was not positive. It happened right around the time that the Chicago parking meters deal was being renegotiated. Mayor Emanuel, for his own reasons, got up on the television and made a lot of negative remarks about the meters deal. Right at the time when you're about to launch a deal. So when you look at the interest that was generated in the Midway deal, it was far less than the parking meters deal or even Midway first time around, because here you have the mayor of Chicago standing up publicly criticizing a P3 deal at the same time that he's going to market for a P3 deal. So whereas in all these other brownfield processes there were 10 to 12 bidders, in the case of Midway there were very few.
Right.
And it shaked out till, well, there were just 2 left. And at the end, one of the bidders dropped out, and I think the city felt at that point that the competitive tension had been lost and it had to pull the deal. So that's the first point I'd make, which is that the process was launched in an atmosphere of negative publicity about P3s in Chicago, and I think investors perceived a little bit of political risk in Chicago. I think the second issue is expectations management on valuation. I think a lot of cities don't value their assets well. They expect to get more than they're worth, and they don't sit back and take a good cold hard look on the revenues that are produced, the term of the concession, and what the net present value of that revenue stream is going to be worth, and they talk themselves into a higher valuation expectation than the market is prepared to provide. Yet all of these deals are done through competitive auctions. So when the bidders are bidding on these deals, the marketplace has basically marked to market the value of the asset for the city. I think in the case of Chicago, there may have been some unrealistic expectations on valuation.
All right, well, that's a shame. However, third time could be a charm. I'm John Marino, and that's the deal. Thanking Kent Rowey for joining us today. Thank you.
Thanks, John.